The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how are you?
Really good, James. I'm a bit pumped up. I've had 3 coffees this morning.
Fantastic. Let's get into things straight away. This week we're going to look at what the massive takeover offer for Origin Energy means for Australia's decarbonisation push. We'll ask when interest rates are going to catch up with consumer spending, and we're going to look ahead to the showdown at the AGL annual general meeting next Tuesday. But first, Tony, my gosh, you're pumped up. How about markets? They are flying today after US inflation came in a little bit better than expected. And that set off at a massive rally on Wall Street. The S&P 500, the benchmark index, was up more than 5%. The Nasdaq was up more than 7%. The ASX is up about 2.8% as we speak. Tony, is this the Santa rally that we've been waiting for all year?
You've stolen my best line, James. The Chook Super Fund just got an early Christmas present.
You beauty.
But yeah, look, I mean, for example, I hold Xero. Now, I've held that stock for a long time. When the results came out and the CEO, Steve Vamos, left on Thursday, the stock crashed. It's got back just about all of it lost this morning as
Fantastic.
Suddenly growth was back. And I think what's happening, investors are just looking through what's going on. They're seeing potentially a peak in inflation, and they're saying that, the shares, those traditional investments that you hold for long-term growth are looking better now than they have for a very long time.
Yeah, I mean, I think the market wants to rally. I think investors want to finish the year on a high note. John Wood from Credit Suisse says the investors are like a beach ball. When you try and hold it underwater, it always wants to pop back up. And I think that's the feeling around markets. The market wants to rally at the moment. And I mean, these US inflation figures, look, inflation was still up. It's still rising 0.4%. But that was a little bit softer than expected. Headline inflation came in at 7.7%. The market was expecting 7.9%. And whoosh, up we go. Do you think these gains we can consolidate these gains? Can we hold on to these gains, Tony, or is this a bit of a sugar hit?
Look, I'm an optimist, James, and I think we could actually crack the record high on the ASX 200, which is 7,800, by the end of the year. Now, what that requires is the market to go up by about 6 or 7%. Now, that's quite a lot, but then again, it almost went up by 3% this morning.
Yeah,
so,
yeah. And Tony, I was just looking at the monthly figures. In the last month, we're up 7%. So, I mean, that would be some end to the rally some end to the year if we could rally sort of, 10, 15% from the start of October to the end of the year. But maybe it's possible. I mean, as you say, it feels like people are starting to look through the gloom and see what's on the other side.
Well, I thought it was good that Deputy Governor Michelle Bullock earlier this week in a speech said that inflation is likely nearing a peak, despite the recent increase in inflation that was in their revised forecast at the RBA. So if the central bank in Australia says it's nearly peaked, then that tells you a lot about their stance towards raising interest rates into the next 6 months.
Yeah. Well, better market conditions are better for deal making, and we're going to talk about the Origin deal in a sec, but let's just check in on one that we've been following. This is the sort of three-way tussle between Perpetual, which has got a merger agreement with another fund manager called Pendal, and then Regal Funds Management, which is trying to come over the top and buy Perpetual before it can do that merger. We had a few more developments this week, Tony, which you covered in the column on Thursday.
Yeah, look, 2 words sum it up, I reckon, James. Fiduciary duty. Oof. Now, basically, I wrote a column about a week ago saying that the Perpetual Board of Directors really had to consider their fiduciary duty to their own shareholders before they proceeded with this Pendal bid, because the amount of dilution that's happening with the issue of 50 million shares or so, which is the currency to pay for the business, was so great that it looked as though their shares would probably collapse down from $30 to $18. So, and lo and behold, the company put out a statement this week saying that they were very concerned about their fiduciary duty to their own shareholders and they're potentially not going to go ahead, which is, I called it the Elon Musk moment. Do you think that was a bit too much? Or
No. I mean, and the reason they're suddenly worried about their fiduciary duty, as you said they would be, is because Regal's come back with this slightly higher bid. So they've put up their bid for Perpetual from $30 a share to $33 a share. And you're right, they are having this. The Perpetual board is having this moment. Do we want to still continue with this deal, or should we back out of it and go with Regal? I guess the question, Tony, is Regal's offer of $33 enough to get the Perpetual board really thinking twice? I mean, they've clearly got their foot in the door. What do they need to do to force it open? Do they need to lift that bid a bit higher, do you think?
Well, they actually told Pendle that there are other approaches have been made. So I think what this is going to turn into is an auction. Now, we haven't seen the other parties revealed, but it sounds as though there's definitely people interested in different parts of the business. Maybe it turns into a big breakup and Phil King happily gets his Perpetual investments and all those great fund managers, value fund managers in there. But yes, look, we'll just have to wait and see. I think the defence that the sum of the parts is $50 or something, which we saw from Hunter Green during the week, is a bit hard to stack up. I mean, you've got to actually have real cash on the table.
Yeah. I don't think they're going to get anywhere near $50, but maybe something closer to $40 from Regal or another party might get the Perpetual board to drop this Pendle deal. We'll wait and see. Tony, let's jump into the main deal of the week. Perpetual and Pendle was a bit of an entree to this banquet that we got on Thursday when Origin Energy revealed that they had an $18.4 billion bid at $9 a share from Brookfield, which is a big Canadian investor, and EIG, which is a US private equity infrastructure investor. Now, the remarkable thing, Tony, is that Brookfield and EIG had been talking to Origin since August and had actually made 3 offers before it was revealed. How'd they get away with this happening in secret, Tony? I mean, Australia's the leakiest market in the world, isn't it?
It is very interesting, isn't it? You compare it to what happened with Mike Cannon-Brookes when he teamed up with Brookfield to bid for AGL. The bid was lobbed on the Friday, it was leaked on the Sunday in Street Talk, and it was dead in the water on the Monday. I mean, yes. I think the difference here is, I think, an intent and purpose behind those bidders and a willingness to go back to the company, discuss the potential to raise the offer, which started at a pretty low level. I think it was only in the sevens.
Yeah, high sevens,
Yeah, and they've come back, raised it twice and got a knockout premium. I think it's about 59%, which is staggering, and a board couldn't just knock that away. It's just so compelling.
Yeah.
I mean, do you think they're going to succeed or?
Well, look, I mean, I think the chairman of Origin, Scott Perkins, and the CEO, Frank Calabria, have done a cracking job behind the scenes, walking these bidders up, getting them to bid against themselves. That's not easy. This is no auction. This is Brookfield and EIG bidding against themselves. So that can be hard to do. But the Origin team have managed to do it. So kudos to them. I think it seems this bid at the level it's got to has got universal approval from shareholders of Origin. That they seem over the moon. A knockout bid, I think, is how it was almost universally described. The interesting thing, though, and I think you hit on this in your column, was what does this mean for the sort of decarbonisation push in Australia? Because Brookfield, as you said, had bid for AGL and now has bid for Origin. They want to put a lot of capital to work in Australia. They want to put $20 billion to work here. They want to go a lot faster in terms of the energy transition than Australia's gone so far, don't they? I mean, talk us through a little bit about what Brookfield wants to do here with Origin.
Well, one of the big advantages of taking this company private is that not only do they have access to the deep pools of capital that Brookfield and EIG have, and by the way, Brookfield's got the largest energy transition fund in the world, which was set up under the leadership of Mark Carney, former Governor of the Bank of England. But once you take the company private, there's $500 million a year worth of dividends that aren't going to be paid to, forced to be paid to shareholders as a public company.
Great
now,
point.
I sort of worked out in the back of an envelope that you could probably borrow at current rates about $8 to $9 billion just using the dividend flow. So this will be probably a very highly levered deal. But their ambitions in terms of the transition are about getting more renewable power out there. They've got the Araurang station due to shut in 2025, which Frank Calabria's all over that. He's been up there many times talking to the workers. That's just going to be one big massive battery.
Yep.
So this is the model for the transition in Australia, and I reckon it's a big turning point. I mean, I think... and this, we can talk about the regulatory aspects, but if the federal government doesn't embrace this with enthusiasm, I'd be very surprised. I mean, do you think that the infrastructure that's there in the grid, though, is going to be good enough to allow them to go ahead with their plans?
Well, I think this is the really interesting thing that Brookfield's local boss, Stuart Upson, has focused on. Origin's got the largest fleet of gas peaking plants connected to the national electricity market. So these peaking plants confirm the renewables that Brookfield wants to build inside the Origin network. So Brookfield can go a lot faster than other companies because they've got this firming capacity. Now, over time, they'll develop more firming capacity, batteries and storage facilities, like you said, but they can get sort of a running start, which, as you say, is what the country needs, right? You know, we're trying to figure out ways to go faster. Brookfield's come in with deep pockets and says, let's go. So what I found really interesting, Tony, is yes, there are some regulatory issues. FIRB, I think they'll get past the Foreign Investment Review Board because Brookfield's done a lot of stuff down here and is well known to FIRB. So that should be okay. The ACCC, the Australian Competition Consumer Commission, that could be more difficult because Brookfield owns transmission and it owns generation and it would own retail under this deal. And that's vertical integration that the ACCC doesn't tend to like. You're owning the whole value chain. But Brookfield says, well, look, the crossover's not that great. But I was interested that Upson's sort of pitch was basically, hey, the country needs this. We need to go faster. So that should outweigh any competition concerns you've got. Do you reckon it's a fascinating argument to me, but do you reckon it will stand up?
Yes, look, I think they've got such a contribution to make in reducing carbon emissions in Australia. I mean, for example, you look at the way Origin has set up those suburban power stations, and if they did that right across Australia in a country with the highest per capita solar rooftop PV, then that itself becomes this whole distributed network of power stations. I mean, I don't know if you've got solar panels. I do. It sort of annoys me. I'm selling them back to the national electricity, or my provider, I'm sorry, at about 12 cents a kilowatt, and I'm having to buy it at coal-fired stuff at 29 cents. So if I could sell that electricity to my neighbour for, say, 15 or even 20, I'm still giving them at a discount to coal-fired power, but it would actually be very intelligent for Brookfield to roll out a whole bunch of suburban batteries, like little power stations that are there for the firming when we need it.
Yeah, well, it's not like borrowing a cup of sugar from your neighbour anymore. It's flogging him a bit of rooftop solar. That's a good idea. Tony, let's cut to the chase. Does this deal get approved by regulators?
To me, I reckon this is going to end up on the desk of Jim Chalmers, and he'll go straight into Anthony Albanese's office. So that's the Treasurer and the Prime Minister, and they'll make a strategic decision. We know that governments intervene, and of course the worst case example of that ever was 2016 when Scott Morrison let the privatisation of Ausgrid drag on for 9 months, and the two potential buyers were Chinese, and he suddenly stopped it. Now, Ausgrid is now, of course, owned by Australian Super and IFM investors, but we don't want that sort of drag the chain stuff. This is a big strategic move by a big global player. Of course, it has to go through a scheme of arrangement, which will take till the middle of next year or early next year. But I would say that the government, if they're politically smart, they'll get onto it fast.
Yeah, I'm with you. I think it will be dragged out a little bit. The ACCC will have a good look, but I think in the end, you're right, it'll get done. One little postscript to this is that so smart of the Origin board being that they've got what's called a ticking clause in the deal. So it's due to close on, I think, the 15th of May. Every month that it gets delayed, the bid price goes up 3 cents. So the delay could work in favour of Origin shareholders. So that's very rarely seen in Australia, something from the US. But look, a little bit of extra cash.
Sounds good. I mean, my little footnote is that if this deal goes through, and based on M&A league tables, which are on announced deals, Barrenjoey will be the number one M&A advisor in Australia for calendar 2022.
Yeah,
now, that's pretty amazing. Barrenjoey and Jarden are advising Origin, and UBS and Citi are on the other side. But those other two don't have enough billions of dollars already stored away to get them to the top of the league table. So that'd be an amazing outcome as well for a company that's only been around a couple of years.
Amazing. And there's a cracking episode of the Fin podcast that looks at the rise and rise of Barrenjoey. So check that out too. All right, Tony, let's move on to our second topic, and that's what does the real economy look like at the moment? We got some very confusing signals this week. The bank results, we saw results from Westpac on Monday and then NAB on Wednesday, and they were pretty good. Look, there's little sign of any stress in their loan books, despite interest rates rising so fast. Ross McEwen had a great anecdote as he talked to the media on Wednesday. Everyone wanted to know, where are the pockets of stress in your mortgage book? And he said, well, we're ringing up the people who we think should be most stressed, and they're telling us, we're fine, thanks for the call. And so there doesn't seem to be much pain going on at all. We do have this strange phenomenon where lots of people took out fixed rate loans during the pandemic. Those are going to roll off. They're going to end in the next 6 months, 9 months, and those people will be switching back to much higher variable rate loans. But the tone from the banks was that the economy's in pretty good shape, Tony.
Yes. Well, I asked Ross that first interview we did with him, is there going to be a recession in Australia? He said no. He doesn't think that the economy will go into a recession. So that's good news. And one interesting aspect of the NAB result, not just the strength of their business banking, which was up 19% to 4.4 billion, but it was the way in which they've pulled back from the mortgage market. They were gaining market share for a long time, and now they're just doing refinancings. They're letting all the what they believe is low margin business to go to their competitors. So interesting strategies being played out by the market there. But did you find that? You covered both Westpac and NAB. Do you reckon the banks are actually about to? This is as good as it gets for a while, or?
I think that's right. We saw the bank's share prices increase about 20-25% since June into these results. So that's a big gain, and there was a bit of profit taking on the days of the results. But the banks are in pretty good health. I think that they've sold off all their crappy businesses. They've mainly paid their customer remediation coming out of the Banking Royal Commission. Look, their loan books are in great shape. They're not bulletproof, but they're probably they're very well run. So look, I think they'll get through any downturn pretty well. But Tony, the interesting thing for me here is we saw consumer confidence this week down, at levels not seen since the GFC and even below that. But we're seeing spending remain very strong. I spoke to the new CEO of Scentre, which owns Westfield, Elliot Rusanow, and he had numbers for the September quarter with spending up 15.6% on 2019 levels. So this is pre-pandemic levels. What's going on here, Tony? The consumer says they're feeling terrible, and yet they're spending like sailors.
Yeah, well, we had an interesting lunch with Ross McEwen and his CFO, Gary Lennon, on Thursday, and there was a bit of a discussion about how do you really take the pulse of the economy. And of course, being a large bank with the largest exposure to business in Australia, especially small and medium-sized businesses, NAB has this unique perspective, which their chief economist, Alan Oster, has figured out a data series, which apparently is much better than the ABS data. That's what NAB claims. And I think the bank boasts that they share it with the Treasurer's Office, they share it with the RBA, and the latest analysis of that data shows some signs of stress are just starting to emerge, and there was no sort of detail about exactly what those particular stressed areas were, but it does seem as though the economy is still very strong and that people are not really suffering under these higher interest rates to this point. And that's the question, isn't it? When does that hit hard? And we can talk about that if you like. But I mean,
yes,
has your home loan gone up quite a bit, has it? Or?
It has, yeah. I think probably like lots of people, I've left it at a certain, or my wife and I have left it at a certain rate for a long time, and we just haven't, with the fall in interest rates and now the rise in interest rates, the payment hasn't changed. We've been either ahead at times, and that's helped. So
that's very intelligent. I mean, of course, during COVID or just before COVID hit, the Commonwealth Bank came out with a 2-year fixed rate of 2.99%. Now, people just jumped on that. They hadn't seen rates that low for a very long time. If you took that loan, you are now face a choice. You go into a new 2-year fixed at 5.94, and if you've got an average loan of $700,000, your repayments would now double from about $1,700 a month to $3,500. So this is a big jump. And, of course, that's why the variable rate of 5.5 looks so attractive, and that's where most people are going. But this is a lot of money to come out of household budgets as they step up. And I think the message from the NAB lunch is it's all going to basically be passed through by February. So that's when everyone will have all of the big rate increases flowed through to their home budget, and that's probably the time we really want to assess what's happening in the economy then.
Yeah, all right. So the question I've got for you, Tony, I'm going to give you 3 choices. Is consumer spending going to crack and roll over in January, at Easter, or at the end of the financial year in June next year?
Gee, that's a tough one, James. I think it might be somewhere between the end of January and Easter.
Yeah,
which is April, isn't it?
Yeah, that's right. I reckon it can hold on a little bit further. I think there's a lot of resilience. I think it's June next year we start to see it come off. But let's see. The festive season usually will sail through that okay, and then next year as these fixed rates roll off, as you've said, there's a lot of money to come out of household budgets. All right, well, we'll come back after the break next Tuesday, November 15. It's the showdown we've all been waiting for at the AGL annual general meeting. We'll preview that after the break. All right, Tony. It's the moment we've been waiting for some months. AGL's annual general meeting will be held on November 15 on Tuesday. This is going to be very exciting. Mike Cannon-Brooks is trying to get 4 new members of the board around the table. What do you think is going to happen? Is he going to succeed?
Look, I think with all of the sounds and noises that have been made by the big industry super funds and others, that I think 3 out of his 4 will get up.
Okay.
I'm just not sure that that John Pollars has got the momentum behind him. I think Christine Holman, Kerry Schott and Mark Twaddell will be directors of AGL by the end of that meeting, which is an interesting outcome for someone who only owns 11% of that company. Now, James, you were on the Fin podcast this week talking about all the moving parts inside this whole AGL drama. And I reckon that was actually one of the best descriptions I've seen of this whole situation, which is incredibly complex and full of larger-than-life personalities. But where do you think it'll land?
I think you're right. I think 3 of the 4, and that will be an extraordinary result. I mean, I don't think we've ever seen a shareholder with that few shares change the board of a massive publicly listed company in this way. That it'll be quite a seismic moment for corporate Australia. I mean, the rule of thumb is generally that 10% gets you one board seat, and he'll end up with 3 board seats for his 11.3%. So that's a big result. But Tony, what do you reckon the Origin deal means for AGL? Is there any blowback there?
Yeah, look, I don't think it's good for Mike Cannon-Brookes to have a very highly capitalised, I suppose you'd say, privately owned competitor moving at a pace with $20 billion in their back pocket, and he's there trying to talk to capital markets for the funding to do the energy transition at AGL. I think it could be quite difficult. So the question is, if these directors that have been nominated by Mike Cannon-Brookes get on the board, what will happen to the chairman, Patricia McKenzie? We know for a fact that Mike Cannon-Brookes is at odds with McKenzie over the way in which this whole election process has been handled. In fact, he described it as bullshit. But will they get rid of Patricia McKenzie? Will this cause even further turmoil? And then where do they get their $20 billion from?
Yes.
Is there going to be a massive capital raising? Will they have to somehow sell half, do some really interesting financial engineering? I don't know. It's a really tricky one.
Yeah, and you're absolutely right. This isn't the sort of beginning of the end for the AGL Mike Cannon-Brookes story. This is the end of the beginning. There's going to be a hell of a lot more to play out because, as you say, just changing the composition of the board doesn't really change anything about their position. They've still got to fumble their way through this energy transition and find the funds to do that. As you say, where does the $20 billion or whatever number of $1 billion required come from? I don't know.
Yes, because remember, that's what Mike Cannon-Brookes said the company would need.
Yeah.
When he did the bid with Brookfield that failed. So he knows he needs it. Maybe we're going to see some other large global entity come and help them out.
Maybe. Well, there's a lot of private capital in the world. Speaking of which, I am off to Hobart next Thursday for the Sohn Hearts and Minds conference down, which is going to be held on Friday. Very exciting. I haven't been to Hobart for a long time, so this is quite a moment.
The Chook on tour. This is going to be good. What are you go and find the first barbecue chicken place, or what?
Oh, I don't know. Well, there's some great speakers. Bill Browder, who used to be the biggest fund manager in Russia before he was basically kicked out of the joint and has now become sort of a thorn in the side of Vladimir Putin. He's going to be speaking. Some great Australian fundies too. Peter Cooper, who I interviewed a couple of weeks ago, he's going to go down and give his thoughts on markets and a stock selection. So that'll be great fun. And it all raises money for medical research, which is a great cause. The brainchild of Guy Fowler and Matthew Grounds and Gary Weiss. And so, look, it'll be great fun. As I don't think Hobart's probably seen as many investment bankers and investors. So, in one place at the one time.
I mean, I've been to all of the previous ones, and it was a very simple strategy. You go to Sohn Hearts and Minds, you listen to the tips, you buy every one of those shares, and by the end of the year, you were up 20, 30%. It was just a lay-down misère. But in this situation now, if you'd bought the shares last year, I think you'd be down quite a lot. You're in very big negative territory. So it's interesting. Yeah. It'll be interesting to see if Sohn Hearts and Minds regains its position as the preferred sort of tipping venue for very smart investors.
Yes, well, we'll have a team of reporters on the ground bringing you all the tips next Friday, so look out for that. And with any luck, I'll be speaking to you on the podcast directly from Hobart, Tony, if we can get all the technology to work, so that'll be exciting too. All right, we encourage your questions here at the Chanticleer podcast. Love getting them. Send an email to chanticleer@afr.com. Good question this week from Alexander Bryant of Fitzroy, who asks, COVID cases are rising again. Is there any chance this will become an issue for markets, or have investors largely moved on? Yeah,
very good question. I really think that it's all about China at the moment. There's a bit of an outbreak happening in the southern part of China in a city. They haven't shut the city down yet, but that's the area of the world that's, I suppose, got policies that allow lockdowns to happen, and that's the world economy has got through reasonably well and quite resilient despite a zero COVID policy in China. But I think everywhere else in the world, it's a case of it's almost like COVID. We're just living with it every day, and financial markets have really moved on.
Yeah, and that's true. And I think there are some hints China might start gradually opening up, but all depends on how their vaccine rollouts go, which seems to have been a bit haphazard for a command and control economy. Tony, before I let you go, I want to find out what you've been listening to or watching or reading this week. Any recommendations for our audience?
Yeah, I've been listening to this really interesting podcast by the Brazen Project called Karina and the King, which is about the former King of Spain, Juan Carlos. Quite interesting at this stage of the podcast, which is many parts. It's pretty salacious, but I think they're promising that there'll be a lot of revelations about. I don't want to say exactly.
Don't spoil it, Tony,
or
please.
anything, but there's certainly a big movements of money have happened when he was king, and I think the podcast goes to explore that.
Fantastic. All right. Well, I've got on my bedside table The Only Crypto Story You Need by Matt Levine. It can be a bit tough to find, but if you use that phrase, you'll get there eventually. With the collapse this week, or the near collapse of this cryptocurrency exchange, FTX, I think it's time to dive in. So there's probably a few like me out there who've had this on their reading list. Well, I think this weekend it's time to make a start.
Well, I hope you find that more enjoyable than my investment in some Bitcoin miners in the United States.
Yes, we'll get some tips from Sohn Hearts and Minds to help you out of that hole, Tony. Before we go, I'd like to give a plug to the Chanticleer newsletter, which is a new email newsletter that we're launching to give you a place to go to find the Chanticleer podcast and some of the best Chanticleer columns of the week. You can subscribe at the afr.com homepage. You'll see the subscribe button up there in the top right-hand corner. And you can get this podcast and lots of great columns sent directly to your email every week. Tony, thanks for another great episode. Another big week next week, and can't wait to speak to you then.
Yeah, enjoy Hobart. See you, James.
Thanks to everyone for listening. If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd, and it was produced and edited by Lap Fan and Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.